Hey everyone, my name is Brittany Cook and Laura Lowe, and Courtney Ellis and I are going to discuss our strategic analysis on Coca-Cola Consolidated. It all began in 1902 when three North Carolina entrepreneurs decided they wanted to bring the popular beverage to the Carolinas. At that time, people did not have instant access to the beverage. Rather than distributing the beverage like they do today, it was manufactured in glass bottles, and they would hand wash all the glass bottles, refill them, and cork them by hand. In 1972, they changed their name to the Coca-Cola Bottling Company and began publicly trading their stock. In the following years, they grew even more and began to acquire entities such as the Coca-Cola businesses in Greensboro, Raleigh, Winston-Salem, and Hamlet. It became incorporated on May 14, 1980. And as they continued to progress, they developed new products such as Diet Coke, which was introduced in 1982. And today, Coca-Cola Consolidated is the nation's largest Coca-Cola bottler in the United States.
Hello, my name is Courtney Ellis, and I'm going to be talking about the internal environment for Coca-Cola Consolidated. And first off, I want to start with the company's vision, which they have set forth as to honor God in all we do, to serve others, to pursue excellence, and to grow profitably. Their mission statement is to make, sell, and deliver products and services better than anyone else. Some of the strategic objectives: optimizing the expanded distribution footprint after the transformation transactions that took place in 2017. That expansion had significant costs with it, and as a result of that, the company has expanded into the Midwest, Mid-Atlantic, and furthering their operations, which originally were mainly in the Southeast. Another is to generate free cash flow in order to pay off this significant amount of debt that was incurred as a result of that transaction. Another focus is revenue management to ensure that they have optimal pricing of the brands and packages that they sell. Last, to achieve synergy and cost optimization in order to continue to reduce expenses and, like I mentioned, to continue to repay off that debt. Some of the key resources and capabilities of Coca-Cola Consolidated include its 76 distribution centers. They also have 13 manufacturing plants in their territories. They have 4,200 vehicles, and then they also have 510,000 vending machines. They have the distribution and manufacturing rights to over 300 beverages. Some of the core competencies of Coca-Cola Consolidated are they have gained significant skill and abilities in producing a variety of beverages. In addition, they have excelled in distributing those beverages across various regions. In addition, they are also known for excellent customer service. It goes back to their mission statement. Also, they benefit from the marketing of Coca-Cola. Everyone recognizes the Coca-Cola brand. It's very well known. It has a strong and long history. And so Coca-Cola Consolidated definitely benefits from that brand recognition, but also the significant marketing funds that are made available to them from Coca-Cola. All right, so moving on to the SWOT analysis, we want to break out and talk about Coca-Cola Consolidated, the strengths, weaknesses, opportunities, and also threats in their industry. So first, let's look at the strengths for Coca-Cola Consolidated. First off, they have a widely recognized product brand in Coca-Cola. That brand alone makes up 88% of total sales volume for Coca-Cola Consolidated, so that's definitely a huge advantage for the company. Also, Coca-Cola Consolidated has a large geographic distribution coverage, and as we mentioned earlier, they have territories in the Mid-Atlantic, the Midwest, and the Southeast, and overall that results in a customer base of about 65 million consumers. Another strength of Coca-Cola Consolidated is they have licensed products from a variety of producers, including Coca-Cola, Dr. Pepper, and Monster. Additionally, they have a very significant batch data processing system that allows them to anticipate daily customer demand of their products And this is very significant to their operations because they are able to plan their daily shipment of inventory to their various stores and locations based on consumer purchasing patterns. So that is a very significant advantage for them to manage their inventory and their costs. They also have significant business partnerships from their connection to Coca-Cola that help promote efficiency and economies of scale for their operations. One of those is Kona. This is a technology infrastructure and a process for the bottlers of Coca-Cola products. And they're also part of CCBSS, and this allows Coca-Cola Consolidated and other bottlers to obtain raw materials and to obtain those at sufficient prices. Now moving on to the weaknesses for Coca-Cola Consolidated, they have, as we mentioned, had rapid expansion thanks to the transaction in 2017. With that rapid growth comes some growing pains, and specifically it was difficult to integrate the IT systems, controls, and also supporting activities of the company across those new regions. And so that remains an ongoing focus for the company. Another area of weakness is that Coca-Cola Consolidated is heavily reliant on Coca-Cola and other companies that produce its products to develop and introduce more products that meet changing consumer preferences. As we all know, consumers are becoming more health conscious, and so that is an area where they depend on their producers to meet those needs. In addition, two of their key clients are Walmart and Kroger. They actually account for 22% of total sales. So if Coca-Cola Consolidated were to lose one of those customers, then it would pose a significant risk to the profits. And then last, the company has significant debt and capital lease obligations, estimated at a little over $1 billion. Opportunities for Coca-Cola Consolidated. Specifically, I want to talk about Coca-Cola is set next year to release a new seltzer brand, which is named AHA, in March of 2020. And so this is just a great opportunity for them to reach that health-conscious consumer. Another area that they have opportunity in is Coca-Cola has some new still water flavors in their Smart Water line. And then last, there's many opportunities for them to sell products online, and also opportunities to use data analytics to better manage inventory and to reach new opportunities in selling products. Last, I want to just talk about some of the threats that face Coca-Cola Consolidated, specifically in the bottling industry. First, consumers are making healthier drink selections, and so that results in purchasing less soda, which historically has been a huge product for the company, a huge driver of profits. In addition, competition with bottlers and distributors of nationally advertised products, and also bottlers and distributors of private label beverages such as Pepsi Company and Dr. Pepper. In addition, laws and regulations that govern production, distribution, packaging, quality, and safety of products can pose costs. And then last, many states actually have regulations that restrict the sale of soft drinks in schools.
So now we're going to do an external environmental analysis on Coca-Cola Consolidated. So first we have political factors, and one of these would include intellectual property protection. So this includes like copyrights and patents, and this is super important because it would be detrimental to the company if somebody else could make the exact same product and had the recipe. Like nobody would go to Coca-Cola to purchase that beverage. Then we have environmental factors, and one of these that really stuck out to me was sustainability concerns. Because the beverage is distributed in plastic bottles, it's not really good for the environment, and it might be beneficial to discover a new material to package the product in. For social factors, we have attitudes and beliefs of potential consumers, and it is becoming more trendy to eat and drink healthier options.
My name is Lowe, and I'm going to talk about current strategies. One of the current strategies that Coca-Cola Consolidated is using right now is a commitment to drive efficiency and reinvest for the long-term growth. They have consolidated 2 manufacturing facilities in the Memphis area, and they've opened a new automated distribution facility in Kentucky. Another strategy that they have done is a partnership with South Carolina hospitals. It shows that they are trying to do those healthier options for people. They are also continuing to expand the lineup of flavors and package sizes. They've started having the smaller sized bottles. They're moving away from sparkling beverages and making more of the still beverages like the flavored water. What they are doing is they have raised prices, which has helped their profits. Next, we're going to talk about the financial analysis. The stock price of Coca-Cola Consolidated rose 68.7% in the first 6 months of 2019. So part of that was the changes that they made and the raising of their price, which of course helped their profits and raised their stock price. January's fourth quarter reported earnings of $1.82 per share, and the estimate from the analyst was only 13 cents per share. Fourth quarter earnings were 36 cents per share, and the analyst had actually estimated that they would have a loss of 83 cents per share. So they this year have way outperformed what the analysts had thought that they would do. The current ratio for Coca-Cola Consolidated is 1.3252. Their gross profit margin is 33.6344 with a net profit margin of 0.4309 and an operating margin of 1.2518. They actually had a negative return on assets of negative 0.5035 and a negative return on investments of negative 0.9555. Those negative numbers do not present an accurate picture of what this company is doing. And since they've made these strategies of where they're buying more and doing more, it is showing numbers that aren't really accurate for what the company or for their financial health. Okay, now we're going to talk about some strategic recommendations. One recommendation that we have is additional product acquisition with exclusive rights to increase company-owned product, such as the Tummy Yummies. Also to acquire licensing rights to produce more healthy drink options to offset decreasing soft drink sales.
Another strategic recommendation would be to increase research and development of additional product to reach more people, because they will be providing various different products, but it can also help the company achieve more of a competitive advantage, and it can also help them remain innovative and stay on top.
Another strategic recommendation would be to increase their number of contracts with colleges and universities to sell those products on campus, and also additional partnerships with hospitals.
Invest in data-powered smart vending machines. These vending machines actually use data analytics to personalize the offerings. This is based on consumer preferences, which is actually compiled based on purchasing history at specific locations. For example, consumers in an office complex are likely going to desire different products than those at a sports park or even a college campus. So to actually be able to personalize the inventory offerings would be a huge benefit to Coca-Cola, and they could use that data as well to maintain inventory levels, because that information could be communicated to those that are delivering the products before they even arrive on site. They could know what products are low in the machine, and they could plan accordingly, and so that would just help to reduce costs, reduce potential waste, and help them to manage that inventory. Another strategic recommendation for Coca-Cola is to create regional market hubs in significant market locations to effectively allocate resources and investment for growth. The company could target resources and personnel to a centralized geographic locations that have significant growth opportunities. So this would allow them to gain cost efficiencies and economies of scale, but also really target areas where they see potential for growth. Another recommendation that goes along with that is to close and consolidate unnecessary locations. So for example, if there's multiple locations that are basically performing the same type of operations or support service, then it might be in the best interest to close or consolidate that into one location. Some key operations like supply chain, accounts payable, payroll, centralize that into one location